The Social Security income restriction may soon disappear. Here is what that could mean for your future. A proposal currently advancing through Congress has the potential to dramatically reshape the way millions of Americans approach working while receiving Social Security benefits at the same time. If you have ever asked yourself whether you can continue working, remain active in your profession, and still receive the Social Security payments you spent decades contributing toward, then this discussion directly applies to you. Even if retirement still seems several years away, understanding this proposal today could meaningfully influence the way you prepare for your eventual exit from the workforce. The proposal is known as the Senior Citizens Freedom to Work Act of 2026. The central concept behind the bill is simple. It would fully remove the Social Security earnings cap for people who have not yet reached full retirement age but are still employed. Not lower it, not slightly revise it, not raise the threshold, but eliminate it altogether. To understand why this matters, we first need to step back and explain what the earnings limit actually is, why it was originally created, why it still exists today, and what the practical consequences could be if it were removed. This is one of those policy topics that appears straightforward at first glance, yet underneath it are multiple layers that can affect your retirement timing, your monthly benefit amount, your taxes, and even the long-term stability of the Social Security system itself. So what exactly is the Social Security earnings limit? Let us begin with the basics. Social Security has an official milestone called full retirement age, which for most Americans today falls somewhere between age 66 and 67, depending on the year they were born. People are allowed to begin collecting benefits as early as age 62. However, if you start claiming benefits before reaching full retirement age and you are still employed and earning income, Social Security applies something called the earnings test. Here is how that test functions in real life. If you remain under full retirement age for the entire year, Social Security withholds $1 of benefits for every $2 you earn above a yearly limit. In recent years, that annual limit has been approximately $22,000, although the number changes slightly over time due to inflation adjustments. For example, if you are 63 years old, receiving early Social Security benefits, and earning $50,000 annually from your job, a substantial share of your Social Security payments would temporarily be withheld. The word temporarily matters. The money withheld is not simply gone forever. Once you eventually reach full retirement age, Social Security recalculates your benefit and credits you for the months when payments were held back. Your future monthly check is adjusted upward slightly to account for those withheld amounts. Over a long enough lifetime, the system is intended to roughly balance out. Still, there is an issue. In the short run, the system feels like a penalty to many people. Workers who claim benefits early often see their monthly checks reduced during years when they are still employed, and many find the rules difficult to understand and discouraging to deal with. The complexity certainly does not help matters. The Social Security Administration lists dozens upon dozens of different compensation categories on its website, together with detailed explanations regarding which types of earnings count toward the limit and exactly when they count. Keeping up with those rules requires genuine effort, both from individuals and from the administrative system that enforces them. The Senior Citizens Freedom to Work Act of 2026 would erase all of that complexity. Under the proposal, a person could claim Social Security at any eligible age and continue earning unlimited income from employment without having even $1 of benefits withheld. To understand whether removing this restriction is a smart idea, it helps to look back at why the earnings limit existed in the first place. Historically, the original reasoning actually made considerable sense given the economic conditions at the time. Social Security was never initially intended to function as a broad income supplement available simply because someone reached a certain age regardless of their situation. Instead, it was designed as retirement insurance. And in the era when Social Security was first established, retirement had a very literal meaning. Retirement meant a person had stopped working completely. You were no longer employed, no longer receiving wages, and no longer participating in the labor force. Retirement represented a clean break rather than the gradual transition that is common today. In fact, the original system was stricter than the version Americans have now. If you continued working, you simply could not receive benefits at all. The logic was that Social Security existed to replace income that disappeared once a worker left employment. If someone had not left employment, then the income had not disappeared, meaning there was nothing that needed replacing. There was also another reason behind the policy that modern discussions often overlook. When Social Security was created, the United States was still recovering from the Great Depression. Unemployment was widespread and deeply painful for the country. Policymakers genuinely worried that older workers remaining employed were occupying positions desperately needed by younger Americans. Within that historical context, the earnings test served two purposes simultaneously. It encouraged older citizens to leave the workforce while also opening employment opportunities for younger generations entering the labor market. As decades passed, however, both of those original justifications gradually weakened. Americans began living longer lives. Medical progress meant that people in their 60s were frequently just as capable, energetic, and productive as individuals in their 50s. The idea of retirement as a complete stop slowly became outdated as more people shifted into part-time work, consulting roles, freelance projects, or continued employment simply because they enjoyed the sense of purpose it provided. The economy also changed the way it viewed experienced workers. Instead of seeing older employees as individuals occupying jobs that should belong to younger people, businesses increasingly recognized the value of experience, mentorship, reliability, institutional knowledge, and mature judgment that develops over decades. As economic realities and public attitudes evolved, Congress gradually loosened the earnings test. Penalty rates were reduced, income thresholds were raised. Then in the year 2000, Congress implemented a major change by eliminating the earnings test entirely for individuals who had already reached full retirement age. From that moment forward, once a person reached full retirement age, they could earn unlimited employment income while still collecting their complete Social Security benefit without any reduction. The Senior Citizens Freedom to Work Act of 2026 simply represents the next step in that continuing evolution. Instead of applying the earnings test before full retirement age, the proposal would remove it for everyone who qualifies for benefits, regardless of age. When viewed through the broader history of Social Security, this proposal is not some dramatic break from tradition. It is really the continuation of a trend that has steadily developed over more than 20 years. Now we come to the funding issue everyone immediately asks about. The first question many people raise after hearing about this proposal is what effect it would have on Social Security finances. That is an entirely fair concern, because the Social Security Trust Fund is already dealing with well-documented long-term financial pressures. Projections show the system facing funding challenges in future decades as the ratio between workers paying payroll taxes and retirees receiving benefits continues shrinking. So, would removing the earnings test make those problems worse? In the short term, yes, it would raise costs immediately. When people claim benefits early while still earning above the threshold, part of their benefits is withheld. That money remains inside the system longer. If the earnings test disappears, those payments would be distributed right away instead of delayed. More money would therefore leave the trust fund sooner. However, over the long run, the effect is much smaller than many people assume. The reason comes down to how Social Security is structured. The system is designed to remain roughly actuarially neutral across a person's lifetime. If someone claims benefits early, their monthly payment is permanently reduced to account for the longer period over which benefits will be collected. If benefits previously withheld under the earnings test begin getting paid immediately instead, those payments are still tied to a permanently reduced monthly benefit caused by early claiming. The total lifetime payout does not rise dramatically. Instead, the timing of the payments simply shifts earlier. Behavioral changes would also influence the numbers. If the earnings test disappeared, more individuals would probably choose to file for benefits earlier than they otherwise would have. More early claims mean more people accepting permanently lower monthly checks, which can actually reduce long-term liabilities per claimant, even while increasing the number of people receiving benefits at a given moment. The most honest conclusion is that eliminating the earnings test would modestly worsen trust fund timing pressures, mainly because money would flow out sooner, and because early claiming behavior could rise somewhat. Yet, it would not fundamentally alter the core structural issue facing Social Security, which is the long-term mismatch between payroll tax revenue coming into the system and the total benefits going out as the population grows older. This proposal might slightly move the needle, but it is not the primary source of Social Security's financial strain, nor would it suddenly solve or destroy the system. The biggest impact would actually fall on individual behavior. Where this proposal could have the most meaningful effect is not on the government balance sheet, but on the decisions ordinary people make regarding when to claim benefits and how they transition into retirement. At the moment, the earnings limit acts as a real deterrent for a particular category of people. These are workers age 62 and older who want to begin receiving Social Security while continuing to earn meaningful income from employment. For these individuals, the earnings limit creates a significant financial disincentive against claiming early. They understand that some benefits would be withheld. They consider the rules complicated and frustrating, and many simply decide to wait instead of dealing with the process while they are still employed. If the earnings test disappeared, that deterrent would vanish as well. As a result, a meaningful number of people currently delaying benefits would probably begin filing earlier than they otherwise planned. For some individuals, that would actually be the correct financial decision. They could use the additional income to ease financial stress, pay down liabilities, increase savings, or simply improve their standard of living during their last working years. Because they would still have employment income, they would not rely entirely on Social Security to pay for daily living expenses. That means the lower monthly benefit resulting from early claiming might not hurt them nearly as much as it would hurt somebody fully retired and depending heavily on Social Security. For other individuals, however, claiming too early without fully considering the long-term consequences could become a very expensive mistake. Claiming at age 62 instead of waiting until full retirement age reduces monthly benefits by approximately 30%. That reduction is permanent and lasts for the remainder of your life. If you live into your mid-80s or longer, the cumulative cost of filing early can become enormous. For many Americans, Social Security represents the only retirement income source that is both guaranteed and adjusted for inflation. The longer a person lives, the more valuable a larger monthly benefit becomes. One concern with removing the earnings test is that it would eliminate one of the practical friction points that currently encourages people to pause before filing. Some individuals benefit from that friction. The system effectively tells them that if they are still earning substantial income, they will not yet receive the full benefit. That delay gives people additional time to evaluate their situation, plan carefully, and sometimes make smarter long-term decisions. Whether the government should shape personal behavior through policies like the earnings test is itself a valid debate. There is certainly a reasonable argument that adults should be trusted to decide for themselves when to claim benefits, and that government should not create artificial complications around that choice. But there is also a reasonable counterargument that removing barriers may encourage impulsive decisions people later regret, especially when dealing with complicated long term financial trade offs that many individuals are not fully prepared to evaluate. If this proposal eventually becomes law, the retirement claiming decision would become simpler and more complicated at the same time. It would become simpler because workers would no longer need to worry about employment income causing benefits to be withheld. A person could claim at age 62, continue working as much as desired, and receive every dollar of Social Security benefits without reductions tied to earned income. The technical complexity surrounding the earnings test would disappear. At the same time, the decision would become more complicated because the timing choice would rest entirely on your own judgment regarding your health, life expectancy, financial needs, and investment opportunities. Without the earnings test functioning as a structural guardrail, you would need to perform that analysis independently. And it truly is a complicated analysis. The important variables remain the same ones that matter in any Social Security timing decision. How long are you likely to live based on family history and personal health? What rate of return could you realistically earn by investing the extra money received from early claiming? What are your expected monthly expenses during retirement? And how much of those costs must Social Security cover? Do you have a spouse whose benefits could be affected by your claiming strategy? And how valuable is Social Security's inflation-adjusted guaranteed income stream compared with the rest of your financial picture? Removing the earnings limit would simply provide the option to begin collecting benefits while continuing to work, which could be highly valuable if handled wisely. Imagine you are 63 years old, still employed, and eligible for a monthly Social Security benefit of $1,400. Receiving that money while still earning a paycheck creates flexibility. You might place the entire amount into savings or low-risk investments. You could use it to eliminate debt. You might direct the money into a health savings account or use it to bridge the gap until Medicare eligibility begins. Those opportunities generally do not exist today if your employment income exceeds the earnings threshold. So what should you be doing right now? Regardless of whether this legislation eventually passes in its current form, there are several steps you can take immediately to place yourself in a stronger financial position. The first step is understanding your own numbers. Sign into the Social Security Administration website and review your projected benefits at age 62, at full retirement age, and at age 70. Knowing those three figures creates the foundation for any intelligent claiming strategy discussion. The second step is honestly evaluating your health and family history. Longevity is one of the most important factors in Social Security timing decisions, yet it is also one of the most overlooked. If the men in your family consistently lived into their late 80s and your mother remains active well into her 90s, that information strongly supports delaying benefits to maximize your monthly payment. If your personal health history points toward a shorter life expectancy, the calculation changes. The third step is determining exactly what you would do with early benefits while still employed. If the answer is that the money would immediately be spent on everyday living expenses, early claiming may not produce the financial advantage some calculations suggest. But if you possess the discipline to invest those early benefits, even in relatively low-risk Treasury securities yielding 4% or higher, the break-even analysis can look very different from the simple comparisons many people make. The fourth step is monitoring this legislation as it progresses through Congress. The Senior Citizens Freedom to Work Act of 2026 has already been introduced and has attracted bipartisan attention because it fits the broader trend toward providing older Americans with greater flexibility. However, bills frequently change during the legislative process. Amendments are added, provisions are revised, timelines and implementation phases become subjects of negotiation. The final version, passed into law, if it ultimately passes, may look quite different from the original proposal. The broader picture here is that this proposal represents the latest chapter in a decades long transformation in how American society views older workers, retirement, and the role of Social Security itself. The original concept of Social Security as a system serving only individuals who had completely stopped working has gradually evolved into a more flexible framework, recognizing retirement as an ongoing process rather than one single moment. People move between employment and retirement. They transition from full-time jobs into part-time work. They consult, freelance, and even begin entirely new careers later in life. The rigid division between working and retired no longer reflects the reality experienced by millions of Americans. The earnings limit is essentially a leftover piece of that older and more rigid system. It was created for an economy where retirement meant leaving work completely, and where keeping older individuals out of the workforce was viewed as economically beneficial. Neither of those assumptions accurately describes today's labor market or today's workforce. Eliminating the earnings limit would align Social Security rules more closely with the way people actually live in the modern world. It would provide workers with additional flexibility and greater control over their financial choices. It would also reduce administrative complexity for both citizens and the Social Security Administration while removing a rule that many people experience more as a confusing penalty than as an effective policy tool. The trade-off is that the proposal would eliminate a structural prompt currently encouraging some people to think carefully before claiming benefits early, and it would modestly speed up the rate at which money leaves an already pressured trust fund. Whether those trade-offs are worthwhile is a legitimate public policy debate. But what cannot reasonably be disputed is that understanding this proposal, understanding how it may affect your unique situation, and planning accordingly are among the most valuable things you can do for your retirement security today. Social Security rules have changed repeatedly during the last 80 years. They are evolving again now, and the people who pay attention to those changes and adapt their planning strategies accordingly are usually the ones who place themselves in the strongest long-term position.